guys, welcome back to another week of Mortgage Matters in Minutes. I'm your host and owner, Brent Rasmussen. Today's episode is we're going to chat about how recession impacts mortgage rates. That's a really more detailed question, but really we're trying to answer how do we know next year or in the future here soon interest rates are going to come down? And a lot of people we're explaining this to, and they ask, well, how do you know this is going to happen? And I can very much say history and financial history repeats itself. So we do know interest rates are going to come back down. They do always during a recession, and we'll show you things and how recessions go into effect. So, first of all, let's talk about some of the key components of research and through the years of why we go into recessions or what are key factors of starting those recessions. So, obviously, number one, the definition of recession is GDP lowering in the previous 2 quarters. That states we are in a recession period and defines being in a recession. So, what happens before that is when we see unemployment hit all time bottom and unemployment starts to increase as much as about a 0.5% off all time lows, we're in a recession. We see consumers reduce their spending, and we're talking to friends, and everybody's saying everything's expensive. I'm gonna have to cut back on this, or I'm gonna have to cut back on that. We're hearing that among our clients, and we're hearing that among our families and friends. Manufacturing and industrial slows down. The inverted yield curve happens where short term rates surpass long term rates. Those things have happened in our past. We've seen those happen during the pandemic, and we're seeing them happen yet again. Lenders, banks, commercial, mortgages tightening credit standards because they're worried about obviously accounts being paid off. And we see that among the mortgage loans is that many types of loans, whether second homes or investment properties, come with extra fees, extra charges right now. We call those points. And many people say, I don't want to pay points. I want to take a higher rate. Well, lenders know in the future, in a short period of time, these loans might be getting refinanced and paid off. And they need to carry these loans in their books for a certain amount of time, generally 3 or more years, in order to break even on the servicing costs. Another factor that happens before recession is stock market declines. And if you talk to financial advisors, they're following all these statistics and see this same financial history happening. Real estate markets slow down. Are we seeing that happen? Yes. We have a lack of supply because of higher interest rates. People are slowing down their purchasing. And then lastly, we have a global impact, a slowdown of the economy, but also consumer and business confidence lowers as well. And we're seeing that happen through statistics that the government is releasing. So let's chat and talk through a couple different scenarios here of why we know recessions, when they go into place, affect mortgage rates and why mortgage rates drop. So let's do a quick screen share here today and pull up our number one chart is reviewing and seeing how mortgage rates and where they've been at over time. So today, November 7th ish, we are at around 7.75. According to this chart, it's not updated since a few days in the past because obviously they call around and make sure they have some reported accurate data there as well. But we can see through time that interest rates all the way back to 1971 in April, once they were recorded at 7.73, have increased up to 16-17%, and then have lowered ever since then. Okay. So we can see this is the interest rates, the blue graph. We can also see is the gray sections here, 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 and here are recessions. And the easiest one to remember in our recessions, obviously, is 2008, 2007 fall, and 2008. And this was a time frame where we can see here that interest rates going into the recession were mid to upper sixes. And after the recession was over, we're in the lower fives, mid fours, lower fives. We see this happen on time here back in 2001 when we had the recession after 9/11 that occurred as well too, or just prior to 9/11. We also see interest rates drop there as well. In the 90s, we've seen this recession. You can see on this chart here, rates have lowered. We can go back here to the early 80s where we've seen rates skyrocket and come down ever so quickly after that time frame. Same thing in the early 70s as well. So after every recession is official, interest rates come down. So let's go into our next chart, which is the Somme rule of recession. that the economic data the St. Louis Fed puts together for us as well, now we can see basically the same thing. And this is a recession indicator. So we're seeing these gray bars here, the same as the last video there of the gray sections that occurred. And as you can see here on this line, here as we're close to zero, everything is performing well. Once we come off of zero and we start increasing that number, we go are in a recession. I would argue currently in November of 2023, we are in a recession in the United States. We'll find that out later that it's official, but I believe we actually are just from the data and the consumers that we're chatting with. So you can see in the 70s, same thing as this number increases off the zero here, we're in a recession. Same thing occurring in the 70s, 80s, 90s, 2001, you can see this big increase here as well. 2007 and 8, we've seen a huge jump here that increased as well. So we can see the enormous jump that happened in the pandemic of the impact. So let's kind of go back and blow this graph up in time. And let's just go back 10 years because some of us can remember the most things happened in the last 10 years. And we've seen the real estate market being very stable and our economy being very stable for a long period of time. Pandemic happened, wham, numbers goes up, and you can see coming back down more stable in 2021, and we've increased. But you can see at the very end right here, we're starting obviously here in June, May, July, going off this line and increasing. So if we go back 1 year, I'm sorry, go back 5 years first, and we can see this graph a little bit as well too, that as soon as we seen in that February of 2020, boom, a recession kicks in off these numbers going up. Same right here. So if we can go in and zoom this in for 1 year, we're looking at November of 2022. We start dipping and staying close to this 0 percentage points line. Once it starts increasing, which we have in April, going above this line, we are heading towards a recession. And when a recession goes into effect, we know mortgage rates will come down. And we've been talking about this for a long time. Obviously, it's not as come as quickly as everyone had hoped. Many experts predicted rates starting to drop in May of this year. Just been a little slower with the Fed's decision on increasing interest rates. But this is the data that we look at here at Mortgage Specialists and the financial education that we can provide to our clients to let them know what is going to happen in the future. All investing is emotionally driven. Whether you're investing in stocks, bonds, putting money in your checking or savings or CDs, we know it's always the opposite of what we think. When the markets are bad, people think more negative. When the markets are good, people think more positive. They're always on this extreme of where things are going. But if we can look at numbers objectively and we can see what the picture really is, because we know history repeats itself, this is why we see mortgage rates dropping here in the very near future, this springtime, possibly next summer, and people will be refinancing these higher loans, but also the market will gradually pick up and get very busy again because people that have been sitting by the sidelines saying the market is not adequate for them because the rates and the costs are all going to mass enter the market at one time and is going to cause huge competition just like we saw during the pandemic. So be prepared for that. Be educated. I know we don't like the rates of where they're at right now, but it's better to get a property and pay a few months of a higher payment knowing you can refinance versus having to fight other buyers over the same house that we've seen happen for many years. And I would argue that's been going on for nearly 10 years now. So here in the Omaha area, but also across the country. I hope you gained a little bit of knowledge of some of the financial information. We'd love for you to continue to subscribe to our YouTube channel here and give us a like here at the bottom of the page. Share this video with your friends, with real estate agents, people that you know that need to understand where we're moving. No one likes a recession. No one wants a recession. But how does that impact your decision among purchasing a home and making your financial decisions moving forward? I'm Brent Rasmussen, owner of Mortgage Specialists, and look forward to seeing you here next week to go through some more important information on mortgage lending, home loans, and all of real estate. Have a great rest of your day. Mortgage Specialists. Driven, trusted, reliable.